Hey guys, good afternoon. Thanks for the intro. So before we start, just a quick disclaimer. I think I probably have been pretty lucky in me doing the whole angel investment stuff. I started about 8 years ago, actually investing in companies, but since the age of 19, I've been building companies myself, and I've built about 10 of this. Most of which weren't really successful, but it never kept me from pushing on. And the funny thing happened that my first company that I invested in ended up selling to IBM for like $140 million. And the second one is still going. It's roughly $500 million company on target to IPO for over $1 billion. And this is, I think, one of probably the most dangerous things that can happen to an angel investor who just hits it at the very beginning without really knowing what he's doing. Because obviously back then I had absolutely zero clue of what I'm doing and what I'm doing. And the next wave kind of that followed this thing was me wasting a lot of money over a bunch of very unsuccessful investments. And I think this is where I kind of stopped and started analyzing what the hell happened here, why that was so successful at the beginning, why it was so miserably failed afterwards. And I think this was the point where I can say that I really became a full-time angel investor. So just everything is basically true story. So just quickly, so what do we invest in? Well, I'll skip all the obvious aspects. Obviously, we're not here to invest in mining, but let's quickly think about the main criteria of investing in tech. Whether it's a traditional investment, in most of the cases, it's not really, even though sometimes it is a disruption of a traditional industry. It's definitely not safe, and the ROI is typically very binary. It's either a big success or a big failure. And we'll talk a bit more about the binary effect afterwards, but that's something that you should take under the consideration if you're considering becoming one. If you'll be investing 50 grand or 100 grand or 10 grand per investment, be prepared to either hit it big or lose all of it. And that's kind of it. The term, again, from my personal experience, at least 7 to 8 years. And that's kind of in line with the industry standard. But again, I invest in about 40 companies myself, and I can tell that that's indeed the number. If you're looking for a short-term investment, that's definitely not the right vertical to get into. The investment side is really all over the spectrum. There are people investing 10 grand now with AngelList and stuff like this. Again, they start with $1 grand. There's, by the way, another great crowdfunding website called Our Crowd, out from Israel, which is actually deployed at least twice more money than AngelList into startups, and only started running earlier on this year. So definitely take a look at it as well, ourcrowd.com. And the share of portfolio. That's, I guess, a question that everyone needs to decide for his or her own. I know that in my case, probably about 90% of my portfolio is startups. So that's kind of what I do, but that's definitely not what I recommend to other people. I think, a fair share of portfolio should be probably, 5% or so. But so, why tech? Well, it's fun. I definitely do it for fun, and I do it full time for fun. Obviously, I'm still trying to make money, but I just love building stuff, and I love helping other people building stuff. And if this stuff can change, our lives, that's even better. So I try to kind of get away from all these apps businesses and another social commerce website, all this kind of stuff, and trying to do really something really significant. But at the end of the day, if I'm meeting the right people, even if I think they have the dumbest idea, I will invest in it, because I invest in people and not in ideas. Obviously, high risk, it could be high upside or could be zero upside. So that's, again, something that you need to take under consideration. And as I said, we're trying to make some real contribution to the world. That's some slide from Australian growth per industry. So yeah, we can see that some stuff around ICT is growing faster than the others, but I don't think that's the reason to invest. I think most of the people understand, as Ian said at the beginning, that mining is not going to last forever, so we need to build something a bit more sustainable. And Australia has been excellent in generating a lot of very good IP, not so excellent in commercializing it, but that's another story. And again, maybe we can help. So basically, my own philosophy: once I invest in a startup, I just write off the whole amount. So now it becomes zero, which means I sleep very good at night, and I don't risk getting a heart attack at the age of 40. And while I assume that most of the people would probably find it a bit difficult to kind of take it all the way there, but again, think about the binary effect, and if you really want to live a healthy life, do me a favor, don't expect huge returns, especially on your first investments. So the team, and that's I guess probably 99.9% of my decision to invest in a company. It's the team, and it happened to me, as I said, investing in teams with dumb ideas, and even investing in teams with no ideas, just because I knew that they'll need some time and they'll figure out something, and eventually it ended up being some of my more successful companies. One of the other reasons not to look too much or not to spend too much time over identifying or trying to dig into a particular idea is because I can't be an expert in all the stuff that I'm investing in, and my portfolio is very diversified, all the way from hardcore IT through telecom, financial tech, a lot of internet, and all the way to ceiling fans and smart toys. So obviously I'm not an expert in most of these fields. I'm a little bit of expert in internet and online marketing, but that's pretty much it. And in most of the cases, especially when looking at the successful companies, 2-3 years in, even the founders wouldn't recognize their initial presentation that they showed to investors. It's really, really different business. And just again, one real example, one of my probably best investments so far, a company called Kenshu, which is the leading digital marketing platform. When we set up this company, we identify a gap in the market, in the SMB market in China. This is where we aimed. We ended up in having half of the Fortune 50 in the States as our clients. So it's kind of, very, very different shift. We didn't shift that much on the product side, but shifting your market focus is also quite a big of a pivot, especially again when we're talking China, SMBs, and US Fortune 50, kind of very, very different. So things will change, and experience is overrated, and most of the people who are trying to do things within their particular field of expertise, they might be just trying to reinvent the wheel because they simply didn't look outside of their very, very narrow perspective. So yeah, I don't mind backing up guys who are 20 years old or 25 years old. That's fine. The product and the risk analysis, again, definitely try to understand what they're building, because as an experienced person, you can give them some advice and sometimes provide them with some mentoring or just some help, even if you're not investing in the company. But try to understand what's the problem they're trying to solve. A lot of people, a lot of startups are trying to solve non-existing problems, and then obviously it's not going to go very good for anyone. And a lot of people are falling in love with their ideas and products. Again, before all of this is even relevant, what's the problem out there? Who's suffering from this problem, and what are the current alternatives? Of course, market, very important, marketing budget. So I've seen very, very few companies failing because of technical risk. I've seen a huge amount of companies failing because they can't market their product, or there's simply not a good product market fit. So definitely, if I would to rate the risks, the marketing is by far bigger risk than the technical one. In today's world, with today's technologies, you can build pretty much anything you want. But if you can't market it properly, or if you have no marketing experts on your team, just forget about it. Just too much competition out there. And every time you hear about viral, just back off and run away. Run away, because viral is a very, very nice buzzword. And again, one of the very few areas where I do specialize in is online marketing. And I probably handled, I don't know, $5-6 billion of advertising online for all the biggest guys on the planet. And viral is not something that just happens. Viral is actually the second part of the story that no one likes to tell the first part, because first part is boring. It's a lot of hard work, and it's months, if not years, of building this snowball until it gets to the position where it actually starts rolling down the hill and kind of getting inertia. So forget about viral. This stuff don't happen. Be careful. Hockey stick graphs, well know that. Personally, I take every forecast, Excel, whatever, and put it right in the trash bin. Seen, I think so far, only one company that actually hit their KPIs and their graphs the way they forecasted them. In most of this, it's not happening. Again, even my most successful companies are very, very far away of forecast, but that doesn't mean it can't be a good company. It just means that the founders don't know how to forecast. That's a different problem that hopefully you can teach them. As I said, solution to non-existing problems, viral, spoken about already, and definitely agree with Bill. Do your own market research and ask experts, especially if that's not something you're doing for a living. There is absolutely no harm talking to someone who is a specialist in this area. Don't be scared of, again, young and inexperienced teams. Sometimes these are the guys who are coming with the most creative ideas, because they're still not living within this box. So they still feel free to think outside of the box. And these are the guys who make real change happen. Technical risk, we already addressed this. Lack of short-term revenue. So I guess I'm a bit of a visionary guy. I like looking at the big picture and at the vision, 5, 6, 10 years from now. And when I invest, I want to see this company growing to be a $1 billion company. I'm not interested in $30 million or $50 million exit, even if it could be nice ROI. But again, I'm there to build big things. And because of this, lack of short-term revenue doesn't really bother me as long as I understand what's the end goal. And some of the biggest companies on the planet, when they started, they had zero clue of how they're going to make money. Companies including Google, even PayPal, before they reached like 4 million users, they made zero revenue. But still, pretty good company. And of course, following your instincts, very much agree with the chemistry thing. If you're not feeling that there is a good chemistry with the founders, just don't bother. It's not going to work. In terms of, again, where to invest, so it depends on your risk appetite. Even though it's not proportional, the risk, I think, is to some extent proportional. Pre-seed, I would probably say that 99% of these companies at seed stage will not make it. Seed, maybe 95% will not make it. Round A, probably somewhere between 80 to 90%, and so on and so on. But obviously, the ticket size are getting bigger. So I think for angel investors, if you're investing a reasonable amount of money, it would be somewhere between pre-seed, seed, and maybe around A. In terms of valuation, I think that's probably the least important one. One thing I can tell you for sure, none of the traditional methods work. I do lecture sometimes at UNSW at their executive MBA program, and then students are trying to convince me that they can use NPV and DCF formulas to calculate values of startups. That's kind of a joke, but I hope you understand why. The main reason is because the risk factor that is calculated in each of these formulas is typically taken as like 30% risk. I would die to invest in startups with only 30% risk. It's typically 99, but then when you apply it, the valuation would be like 10 grand. Okay, probably it's not going to be the right valuation. So basically, since it's an open market, well, more or less open market, it's whatever you're willing to pay and whatever the guys around you are willing to pay, because an angel investment is not typically something that you do on your own. There would be a syndicate, even if not syndicate like Sydney Angels or something like that, but there will be other guys. So eventually, it's a matter of negotiation and understanding. Very important thing, if you're about to invest in a company, let's say on $2 million pre-money valuation, and then for some reason the company raises the valuation to $2.5 million and you decide not to invest. So actually, good thing you decided not to invest, because that means that from the first place, your decision making was wrong, because this another $500,000 or whatever, 20% in the valuation, it's not the thing that's gonna make the difference at the exit point. Whether it will be zero, so it will still be zero. If it will be a big hit, it wouldn't matter. You would still be happy with the outcome. My personal approach is always to think about what's the best interest of the company. So once I'm investing in the company and becoming part of it, and I'm personally also becoming very much hands-on involved in the company, but again, I'm doing it full-time, so it's not a hobby for me. I actually there to help company grow. Once I decided I want to progress with a certain investment, I stopped thinking about my personal benefit as an investor, and I only think about what's good for the company. So one of the things, for example, I never ask for any preference. I don't like preferred shares. I'm happy with the common stock, and I encourage everyone to take common stock. Eventually, it's in the best interest of the company, and I can give like a whole lecture why, but we're short in time. Just kind of that's my philosophy. Respect the entrepreneurs, even if you're not going to invest in them. Just provide them with some feedback, and try to send them home. Hopefully, with some homework and some thoughts. Aiming for the long term, as I said, 7-8 years at least. If you're after 3 years, just put your money in the bank, I guess. And don't spend much time minimizing the downside, getting your lawyers to craft 40 pages shareholders agreement, because it wouldn't matter. If the company will go south, it doesn't matter. You wouldn't get any money out of it. And that's why it's not worthwhile spending your time, your lawyer's time, and losing this positive energy within the team. The portfolio approach. So I like to compare it to the roulette rule, or if you're going into the casino and you put $100 on 26 black, and you do it once a year in the hope that it will hit it. Well, I guess you all understand that in most of the cases it won't. So definitely build a portfolio, and absolutely agree with what Bill said. If you want to invest $500,000, just spread it across at least 10 investments, maybe even 20, and that would be your best protection, even if you don't understand anything about any company that you invested in. But if on top of that you will also follow some expert and try to join some syndicates and do very, very basic due diligence, it will increase your chances by a significant amount, rather than just putting it in one or two chunks, large chunks in companies. And yes, you'll get 20, 50, 60% of the company. It doesn't matter. If it will fail, all your money will go to the same place. Try to diversify vertically. Again, if you're not a particular expert in one field and you want to invest just there, just try to diversify as much as you can, because good ideas and good companies come from all kind of different places. If you can diversify geographically, great. I'm seeing a deal flow from 10 different countries, but again, obviously not everyone can do it. And stage the diversification is something that happens along the way. So if you're consistent with what you're doing, you decided to invest this $500,000 or whatever, and you're doing 2-3 investments a year, over time your portfolio would be stage diversified as well. You'll have companies that you invested 5 years ago, and you'll have companies that you invested yesterday, and this will provide with a reasonably good exit horizon. Obviously, again, hoping that at least some of the businesses will go somewhere. And again, never ignore your gut feeling, but never believe it's enough. Thank you very much.